Welcome back to Keeping Up With Thandi. The first lesson on time value of money made Thandi excited to learn more about financial management, which brings us to this unit on financial statement analysis. But Thandi's story continues. She's not necessarily a people's person, and she prefers doing most things alone. It is difficult for her to make friends in university because she's in a new place and also because she doesn't necessarily have time to socialize. However, last weekend, her housemates invited her to a house party in Sandton, where she was able to meet and mingle with new people. She mingled with a few of her classmates and they spoke about their courses and how they cope. What she understood the most from each person's story is the importance of being able to cope with whatever it may be that life brings towards you. That lesson was tested when she got a call on Monday morning informing her that her mother had been hospitalized. She was so devastated with the news that she couldn't even go to class. It is unfortunate that life has no sympathy for the situations we go through, so let's try to fill Thandi in on the class she missed about financial statement analysis. Firstly, stakeholders need accurate and timely information, and accountants prepare this information and present it in two main statements. The first being the statement of profit and loss, otherwise known as the income statement, which records all the income and expenses for a particular period. This statement also provides information on profit before tax, tax and profit after tax. The second other main statement is the statement of financial position, otherwise known as the balance sheet, which records all the non-current and current assets, including the non-current and current liabilities, together with the equity, as at the end of the financial year for the company. Another financial statement available is a statement of cash flows, which records cash flows from operating, investing, and financial activities. It is important to be able to identify and interpret this information from a financial statement. Sometimes one can take certain items from the balance sheet or the income statement and convert it into a ratio, which is comparable to other companies and industry standards. This is one of the easiest and trusted methods to get an overview feel for the relative strength of a company. Ratios are calculated amongst the different elements that make up the financial statement, such as the following: assets, liabilities, equity, income, and expenses. Ratios can be grouped into categories. The following broad categories provide a useful basis for explaining the nature of financial ratios. Profitability ratios measure how efficient the firm uses its assets and how efficient the firm manages its operations. Financial leverage ratios address the firm's long-run ability to its obligations. Market ratios can also be calculated directly from publicly traded companies. Liquidity ratios are intended to provide information about a firm's liquidity. Its primary concern is the firm's ability to pay its accounts over the short run without undue stress, particularly interesting to short-term lenders. And lastly, turnover ratios, which measure how efficiently or productively a firm uses its assets to generate sales. All of the above information summarizes financial statement analysis.